markets are going to do well from some period before the announcement to some period after. The surprise component, like COVID, people panic. I mean, they have a right to panic because you cannot accurately predict risk. And that's really the underlying theory, right? Risk has to be managed. It has to be managed on a corporate level, and it has to be managed on a personal level. And so in that process of managing risk, you need good information, and you need all the information you need. And that's actually part of the problem with modern, the modern markets, is we are so overloaded with information. And in many cases, what looks like good and accurate information is not necessarily that. It can either be spoofed, or someone that looks like they're an expert can validate the information, but it's one person validating the information of another, and maybe they're partners in this process. We just don't know. And it's very hard many times to figure out. So because of that, people have less tolerance for variance of projected or expected outcomes. And this is, we see this a lot when the markets become very volatile. Certain market intermediaries like Merrill Lynch will come out and say, don't react to the market being down 700 today, right? It's not that bad. It may well come back, right? Don't overreact and sell everything. But, especially now with all the foreign capital in the U.S. markets, it's not easy to contain the reactions. And so you get, because the public markets, especially the public markets, are driven by supply and demand, and supply and demand is driven by personal preference and opinion, then when something happens that we weren't expecting, that will cause an immediate reaction on the part of many people, both domestically and foreign. And that reaction is seen profoundly in the public markets, whether it's stocks or bonds or commodities, right? So, I don't think this is going to happen, but Russia keeps, playing the nuclear option card. Now, as I said, I seriously don't think it's going to happen. But every time that Russia plays the nuclear options card, a whole bunch of investors get very nervous. And you can see that in the in stock market prices, right? So effectively, the whole process isn't really rational anymore. It's not really efficient, and this is public market theory, but markets are efficient because investors have a pile of information on which they can trade. But the problem is that the surprise element has become more and more profound, right? So it's not little surprises anymore, right? It's not North Korea lobbing a missile downrange, into the Sea of Japan, right? It's a major viral outbreak. It's Russia threatening nuclear war. It's really hard on those level of surprises to predict what the price changes are going to be, to think that the markets are going to be calm or efficient, right? Markets are going to be highly volatile, greater standard deviation with greater standard deviation for a period of time. And that period of time is going to continue until we find a moment of not necessarily peace, but stability. So Russia stops lobbing missiles into the Ukraine. They finally sign some sort of agreement. The nuclear threat of war goes away. Someone talks to Korea and says, stop it because you're too small a country with too small a budget, with too small a military to take on NATO and the United States, which is what you're heading towards. So stop it and focus that money on better industries, better roads, better health care. And someone will eventually have that talk with the North Korean government. So if the North Korean government stopped lobbing missiles downrange, and if Russia stopped playing the nuclear card, and if China came back and said, we're part of the world economy, and we are doing some business with Russia, but we don't necessarily support them, at this point, so that it looks like there's going to be peace there. And by the way, we're not going to invade Taiwan because we don't have to. All of a sudden, right, the markets would operate on a more predictable, more efficient manner. But I can tell you, with the combination of computers and piles of capital in the hands of these major trading desks, like at the hedge funds, the markets are not improperly priced for very long unless there's some big pool of capital making it improperly priced. And my my favorite example is GameStop, GME, right? And GameStop went from 14 to 400 in, I think it was 3 months, might have been 4 months. And I don't know if you followed what happened there, but GameStop was a great business model in the day. Bring your old games in and we'll pay you some money for the old games. We'll resell to someone else, and then you can use that money to buy a new game. They didn't pivot into an online format. I think they're starting to do it now, or have done it a little bit, but they didn't do it. So their earnings dropped. And again, management decisions that we make, right? One of the ways that we can cause earnings volatility is that our expenses become structural. So, imagine if you were running a consulting company and you announced that we're going to give everybody a 2-year contract. So that means you're stuck with your workforce for 2 years from the day you sign, your first set of contracts. If the next year your business falls off dramatically, your earnings are going to get clobbered because you've changed a variable expense, labor, into a fixed expense, labor with a contract. So what they did at GameStop was, in order to have the best locations and be in the best places, they leased all their stores themselves. So all their stores were on their balance sheet. So as revenue dropped, earnings dropped even more. So what happened was that 2 hedge funds started shorting the stock, and they shorted too much. And here again, the decision they made was that no one at these hedge funds woke up and said, geez, we're short an awful lot of the stock. If any pile of money came in and started buying the stock, we could be in big trouble. The stock price could move up dramatically, and we would then be forced to put up capital or to cover the short. I don't know why they never thought that would happen. But the next step in the play was that all those investors were communicating through Reddit. And, members, I don't know if you followed it, but, we're going to stick it to Wall Street. Well, it wasn't them that caused the problem. The problem was that behind them were big piles of capital. Other hedge funds who were just buying up the stock. and they were buying the stock every day. And every time the hedge funds that were short went to cover their short and buy a little more stock, the other hedge funds that were running the price of the shares would come in and buy the shares. And then the individuals on Reddit would all, coordinate with each other. And boy, we're making so much money. You got to keep buying the stock. And they literally ran the stock to 400, right? That had nothing to do with market efficiency. It had nothing to do with the real value of the enterprise. The enterprise was, GameStop was hugely overvalued at 400 a share. It was probably overvalued at 50 a share, right? But it, it was just strictly an inefficient market that drove the share price up, right? So effectively, this concept of efficient markets involving random price changes because we can't predict surprises is like, yeah, you know what? That's not really an efficient market. Because an efficient market would reflect the true value of the underlying enterprise. It really is an inefficient market. And inefficient markets are how you make money as an investor. Just as if you're running a company and if you can, borrow money at 5% and invest it by buying another company at 20% returns, right? That's not really an efficient market. An efficient market should say, oh, the 20% return's too high. You're going to have to pay more money. You're going to have to pay a lot more for this company and get that return from 20% down to 10. So my concept on markets is that all markets are inefficient. All markets have a random factor that every investor tries to take advantage of. And whether you're trading stocks or bonds or commodities or buying companies, or you're making decisions inside of a company to expand either through an acquisition or through expansion of your current business or both, what you're looking for is a mispricing, an inefficient market that has mispriced some part of your business. And you're going to deploy capital in to take advantage of that inefficiency. So I'm as you can tell, I'm not a big fan of the efficient market theory. All right. So, sorry, you have a question?
Yeah, I was just thinking of something. Could you go back to the last slide for a second? It was on the last.
That one?
Yeah. Oh, okay. This was what it was. I was thinking about like the markets overall in terms of like the large, longer term like cycle of the bull and bear market. What's interesting about this market is how you were saying the efficiency versus inefficiency. It's like both almost, because you have this period of long periods of efficiency, which is like what we learned in class, which is like the autocorrelation, or how they all are together, right? The periods of efficiency are clustered together, and the periods of inefficiency are also clustered together. So you had this big run up, right, where there's no drawdown or anything really happening besides that one time, and no inventory was not. It was accumulated, but it didn't have the chance to be deleveraged, if that makes sense. So like we went through that, but it was, people would say that that's the bad thing, but if there's no reduction of like what's capitals out there or these types of things, then, we just really had just like that long period of efficiency. And now, of course, the markets are going to have periods of inefficiency because you can't be efficient for that long. It's unnatural almost. That's why I was just thinking of it in that kind of like like how you think of elastic band. It is natural for it to contract back and be inefficient in order to maybe remove some of this inventory at higher price levels, like the open interest, if you will, like SPX open interest, or these things. They accumulate for so long, and then if they don't have a period they can be removed, then these assets, these hedges need to be repriced or something, along those lines.
Well, look, as I said, this is my personal view.
Right, right,
Is that markets transition from inefficient to efficient and back to inefficient in very short time frames, and that causes market volatility. So the one thing I think we could all agree on is that public markets, whether it's bonds or stocks or, as I said, or commodities or energy assets, you can almost pick your personal flavor of financial asset. They've all become much more volatile
right.
than they ever were. And that's because there's a lot more surprises, number one. Number two, there's a ton more money floating around. And number three, the control of that money is much more concentrated than it's been in for a very long time. And so in a concentrated capital environment where everyone's worried about the next surprise, which of course is by definition almost impossible to predict, the markets have to have greater volatility. And that, I believe, explains the volatility portion, right? And so in the process of greater volatility, things get too cheap. Big money comes in and buys it, and the markets go back to being properly priced. Markets get too highly priced, big piles of capital come in and short the market and drive the values down to properly priced. And that's why, as I said, I think in a sense we're seeing greater standard deviation, greater variance of all of our financial asset markets on a global basis over the last really 3 or 4 years. Right? And COVID and the net result after COVID has caused even greater concentrations of wealth than we ever imagined. And what I really think it's done is I think it's probably exposed these greater concentrations of wealth. I mean, I had no idea how many billionaires were floating around Russia.
Russia?
Yeah. But there's a zillion of them. I mean, when you think about it, I think the number is 52 yachts were seized of Russian billionaires, and they didn't care.
Yeah, I'm not surprised.
The darn boat's only worth 40 or 50 million. Who cares?
Right.
So in effect, what we've seen now is how much concentration of wealth there is. And that concentration of wealth is going to continue to cause greater variance and greater standard deviation in all of our public markets on a global basis, whether we like it or not. And that means that the reaction to surprises will be greater now than they ever were.
Right. Yeah.
So that's,
So
this is the world we're living in right now. And we're living in it whether we're talking about corporate management, whether we're financial management at a corporation, or we're talking about investing our own money, or we're working at a money manager. We're all caught up in a much more volatile period, right? And then you can add in the surprises used to be financial. Oh, Exxon's earnings were way less, or Google's earnings were way less than we thought. So let's trash Google, right? Now the surprises are, the fighting broke out in Poland, and a whole bunch of people got killed, and there's a rumor that the Russians may invade, which would trigger NATO coming to Poland's rescue. Now what? Now what do we do?
Right.
So that's the problem, right? It's the good news is we have a lot more information at our fingertips. The bad news is we have a lot more information at our fingertips. And the worst news is that technology has progressed to a point where it's really hard to figure out what's real and what's not real. Right? I saw a buddy of mine sent me a video where he was talking to Donald Trump, and he was they're planning part of Trump's portfolio. He's an investment manager. I
Yeah.
didn't. It was a deep fake. I didn't know it was a fake.
Oh man. Oh
Yeah.
no.
I said to him, I said, when did you go to Florida? And he said, I didn't. He came and saw me because it was the conversation took place in his living room. I go, yeah, I recognized you right, the couch. He came to see you. That's amazing. It was a total fake,
I see. I see.
right?
Yeah.
How do we know that now? So we're caught up in this world where you really can't rely on markets to be efficient. And you can't rely completely on information to be true and real.
Right.
And this is part of being a good financial manager is having the resources to check everything out and taking the time and effort to check everything out.
Gotcha, gotcha. Is that kind of the same thing with bonds too? Because like that surprise factor, every time we see the Fed release, there's obviously huge variation in, where's the interest rate going to end up as traded by the market,
Here's the thing about bonds, right? So if you think about it, we've talked about three asset classes tonight. One being we're going to buy a company. The problem with buying a company is that it's very hard to get rid of the company. So if you made the wrong purchase, you're sort of stuck, right? You can maybe get rid of it over time, but you're essentially sort of stuck. With bonds, as long as you haven't made a bad credit decision, you just hold on to the darn thing. You get income every so often, and eventually, by contract, you'll get your money back, right? And the courts are supportive of you as the lender slash investor getting your money back. So you've got a path of recourse, and you're getting paid over time. Stocks, you're an owner. You're getting nothing, right? You may get a dividend, you may not. They may suspend the dividend. They may reinstate the dividend. They may suspend it again. So you can't count on getting any income. The only income you can get is that the market will properly price the security you own. And when I say properly price, I mean in line with your estimation of the future direction of that security, and you're going to make money. You're going to get a capital gain.
Right, right. I think that it's the crux of it because like households have been putting a lot of money towards treasuries in recent. Like if you look at the graph, as of recent, they've been picking up because I think they think that's safety. The government's not going to fail. Obviously. So they probably that's probably one of the reasons.
Well, we hope not. We're not 100% sure what happens with the debt ceiling, but we're all kind of hoping that everyone down in Washington takes a big boy pill and makes an adult decision. But I can't guarantee it.
I think I know that most things they don't do, but when it's financial stuff, people take that seriously. So I think they're going to do the right thing. Everyone's going to do the right thing.
Yeah, well, I mean, you hope so, but they have in the past, and the sort of the varsity sport in Washington D.C. is brinksmanship.
Brinksmanship.
Brinksmanship. We make the decision at the last minute possible.
Okay.
Right? So we've had a number of instances where we've butted up against the debt ceiling. This is nothing new, right?
Right.
And if you go back over history, a couple of them, I don't think the last one, but the one before that, what they do is they lock the doors of Congress and they turn the clocks off at 11:30 at night. Because at midnight they're going to default. They don't get to midnight.
Right. Like the doomsday clock.
Yeah. So they stop the clocks. They come to a decision. The news cameras come in at 6 or 7 o'clock in the morning and they go, oh, we did it. And we increased the debt ceiling and the world's okay. And we're going to pay all the T-bills that are maturing today. We're going to pay them off and everything's okay. And the news tells us that and we go about our business. Right. But they were there all night to iron it out and had the clocks struck midnight, we would have defaulted as a nation, which we can't do. We cannot afford to do. And honestly, if I were president, heaven help us, I would call I'd call every person that touched the debt ceiling in and say, you got to stop this. You got to come to an agreement. And I'd call up Powell and I'd say, let's have breakfast because you got to lower interest rates.
Right.
Right? We can't keep paying higher interest rates on the public debt. We just can't do it. Well, we can do it, and the way we can do it is we can just tax the heck out of you folks.
Right.
Which is not going to be a lot of fun. All right. So anyway, total return now is obviously simple, very simple math. The concept here that I just want you to understand is that in unexpected returns, there is a systematic portion, which means it comes from the overall environment, and then there's the unsystematic portion, which comes specifically from some sector of the economy or within the company or a specific stock. And so effectively, what you're looking at when you're calculating or predicting total return is you're looking at what you expect to happen. And to that, you're adding the unexpected portion that will hurt the economy, the overall economy or overall stock market, and then the specific portion that, yet though it's unexpected, affects the company in which you're investing. And that's systematic and unsystematic analysis of returns. So here again, just so you understand, systematic risk is market risk, right? And it has to do with fairly broad economic occurrences and their impact in a fairly broad manner on the economy. So, like I said, if Putin lit off a nuclear missile in the Ukraine, and Biden gets up and says, "That's it, game over. We're giving $400 billion to NATO, and we're taking over all kinds of weapons, and Russia's going to be really sad that they did this." That's going to have a major impact on our economy, right? And we're probably going to be in an environment where GDP is going to go down because people are going to demand less goods and services. I mean, people are essentially going to hunker down in their homes. And at the same time, the government's going to increase our deficit because they're putting so much into fighting Russia. And interest rates have gone up now because the economic geniuses down in Washington can't figure out the difference between demand pull and cost push inflation. And I'll just tell you, from someone who has studied economics for a long time, demand pull inflation you can fix by higher interest rates. So, effectively, a dollar hits your bank account and you got to look at where it's going to go. And one of the places it's going to go is to pay off those higher interest rates, which is going to give you less money to buy stuff. And so you can modulate demand through higher interest rates when it's demand pull inflation. When it's cost push inflation, higher interest rates don't matter because the elements of cost are passing along that higher, the higher cost or greater demand for profitability or whatever is causing the price of those commodities and those goods and services to go up. They're just passing the costs along to us. So we're paying more. So if you look at current inflation, it's cost push, it's not demand pull. And the costs are very much based on the shortage of housing. So housing costs are going up, and the higher price of fuel, which is causing electricity to go up, and it's causing the price of fuel at the pump to go up, and the decisions made by the major automobile manufacturers cut back on production way back in 2020, we're still feeling it. And the cost of used cars, every time the market, the dealers try and push the value of used cars down so they can buy them cheaper, and because they're starting to sell more new cars, the consuming public goes, I don't need a new car. I don't need to pay sticker on a new car where I used to pay 5 or 10 grand under. All right. I don't need that. I'll buy a used car. And all of a sudden the demand for used car goes up, and so used car prices go up, and guess what? Used car prices are in the consumer price index. So all of a sudden we've got inflation. So hopefully they'll wake up down in DC and stop killing us with these higher interest rates. Anyway, the thing about systematic risk is you can't diversify it, right? You can't diversify it, and you can't hedge it. So, you can sort of hedge out interest rate risk if you're a corporate borrower by locking in current rates, but that's just a guess because rates could be lower in 30 days. So if you're thinking about borrowing more money, you're thinking, all right, let's lock in today's rate. Well, if you do that and you hedge out your cost of rates by using the options or the commodities markets, a month from now you may be taking losses on your hedge. Now, the good news is that the offset is that you'll borrow at lower costs, but you haven't really hedged out your risk, right? Because you don't really know what the risk is in the future. You're making a guess, right? And so market risk is, and especially when you get into the public markets like stocks and bonds, market risks are just not hedgeable, right? You can't diversify it out. You can't hedge it out. There's too many factors and it's too broad, right? Unsystematic risk, you can definitely hedge out and you can definitely diversify out, right? It is unique risk specific to a certain asset, to a certain asset group. So if you wanted to buy auto stocks because you thought that in the next 3 years everyone was going to sell off their gas-powered cars and buy electric-powered cars, and the car companies are just going to make a lot more money, in that sort of an environment, you would have a unique risk to the automobile business and maybe even a more unique risk to Ford Motor Company. Now, all of a sudden, the United Auto Workers says, we're not getting our fair share of all this huge profit that the automobile companies are making as they sell these electric vehicles to people. We want higher wages. All of a sudden, you're caught up in this unsystematic risk. Now, you can diversify it, so you could sell Ford calls and buy Ford puts and create a collar, and effectively, if Ford went down a lot, you could sell your Ford shares off at a definable price, right? So you can hedge that risk out, but the broad risk to the U.S. economy of higher rates and so on, you can't hedge that out. So that's the major difference between systematic risk and unsystematic risk, is that unsystematic risk you can hedge, you can diversify out, right? It's a risk that you can manage out of your portfolio taking certain actions. The systematic risk you can't. It's too broad. And as I said, this whole concept of diversification, which was really sort of the first way that we thought about managing risk, both in an investment portfolio and in a corporate management portfolio, in corporate operations. Diversification was the first way that we thought about how to manage risk. And the way to do that, obviously, even inside of a company, is still available to us, and that therefore, we can, as I said, we can buy another company whose earnings are totally not correlated, non-correlated to our baseline company. So we have two companies under one umbrella, same management team, but one company is our earnings are totally not correlated. We saw that in that chart before, totally not correlated with the other company that we bought, right? Well, that's the beauty of diversification. And you can definitely see that in in an investment portfolio. In an investment portfolio, diversification is a big factor in managing risk. And as I said, we've come to sort of a different time in the investment world where some investors love risk, want risk, and remember the risk and return are highly correlated, right? So the higher the risk, the higher the return. That's really the definition of an efficient market. The more risk you take, the more return you should get. Now, there are certain pools of investor capital that love risk, and hedge funds being sort of the primary culprit. They'll take as much risk as they can get, so long as they understand the risk, and so long as they can create a probability of that risk hurting them. And there are hedge funds that have billions of dollars under management that only have 3 or 4 investments. And they'll invest multiple billions of dollars in a single investment strategy because they have convinced themselves that the probability of failure is much less than the probability of success. And they'll live with the probability of failure in order to get to the probability of success. But in a standard investing environment, whether it be your personal portfolio, corporate portfolio, or corporate operations, the easiest way to reduce risk, the easiest way to reduce standard deviation and variance is to use diversification and to use non-correlated assets. And if you do that, then you can get to a point where effectively the main risk you're dealing with is systematic risk. So in the markets, it would be the broad index, the broad market risk. It wouldn't be your specific stock risk or even your sector risk. And in the stock markets, you just cannot get rid of systematic risk, right? And it ain't going away, and you're going to have to deal with it. And that's where, if you're a portfolio manager, that's where you spend a lot of your time, is trying to figure out what is the systematic risk right now. And part of the problem in this world in which we live today is that the surprise factor is extremely high. And between the weather, I saw an article yesterday that it just made me laugh, and if I can share it with you. So once upon a time, I had an office out in California in Century City, out in Los Angeles, and the weather never really got cold, and it never really got bad. Well, apparently there's a blizzard warning in Los Angeles County. The Weather Service issued a blizzard warning. I'm thinking, blizzard mean like high winds and snow in Los Angeles County? No, it can't be. But apparently that's part of our surprises that we're having to deal with in creating, investment strategy. And so, you can see this if you go through history. You can see where diversification can help to a point, but you cannot diversify away systematic risk. So, this'll, if you're into looking at the market a little bit, I just want to point something out to you. So the standard theory is that in a portfolio of 100 stocks or more, so whether, and it doesn't matter whether you buy 10 shares of 100 stocks each for a total of 1,000 shares, or 100 shares of 100 stocks each for a total of 10,000 shares or more, doesn't matter, right? If you buy 100 shares, 100 stocks or more, then you'll see that the ratio of the portfolio standard deviation to the standard deviation of your single stock is about the same, whether you own 100 shares or 1,000 shares, 100 stocks or 1,000 stocks, meaning that diversification stops working at 100 shares. So once 100 stocks. So once you own 100 different companies in your portfolio, you effectively have diversified down, you've diversified away all your unsystematic risk, and the only risk you're dealing with is the systematic risk of the market. All right, and you'll notice here, and the standard deviation of the returns on your portfolio, you'll notice that essentially it flatlines at 100 different stocks. So if you were a money manager and you were building a portfolio, and you wanted that portfolio to essentially mimic the movement of the market, you picked the Dow 30 index as your bellwether, then you could buy 100 stocks, or your S&P 500 maybe is a better example. So you say, I'd like my portfolio to effectively mimic the S&P 500, but I don't want to buy 500 stocks to do it. Now, of course, you can buy the index, but what this chart says is, look, you don't have to buy 500 stocks. You can buy 100. So if you buy 100 stocks, then effectively your average return, your average standard deviation of your returns is going to be the same thing with 100 stocks as it is with 500 stocks. There's almost no difference. Just as the ratio of your portfolio standard deviation to your single stock deviation in a portfolio of 100 shares is virtually the same thing as in a portfolio of 100 stocks as it is in a portfolio of 500 stocks. And this is why they say once you get to 100 different companies you own, you in a sense have lost the benefit of diversification. However, just to point out to you, if all you own are 10 stocks, or let's play the hedge fund game, we own 4 stocks, right? We own 4 stocks. Look how much more volatile our portfolio returns are. So if we guess right, we're going to get, almost a 30% return, which meets the hedge fund metric. Most hedge funds are trying to get 20 to 25% returns, whereas if we own 100 different stocks, we only get to 20% returns, which is somewhat acceptable, but somewhat subpar. All right. So effectively now you can see why a lot of hedge funds only make 4 to 8 investments, right? And sometimes as few as 2, right? Whereas a big portfolio manager like a Prudential Insurance or a Jersey Teachers, right, or a California Pension and Retirement System will buy hundreds of different stocks because they want to mimic the index. Then they may try and beat the index by some of their stock selections, but effectively they want to mimic the index. All right. So as you can see from this chart, sigma, which is this portfolio volatility, you can see that the bigger the portfolio, the lower sigma is. And sigma starts to fall after 40 stocks, right? And as I said, by the time you get to 100, you're pretty much mimicking the movement of the index. All right. So here's a good graphic of these two slides. All right. And so you can see that what happens is that when you get, this is 25 stocks, but clearly when you get to 40 stocks, you've pretty much lost your diversifiable risk. When you own two stocks, your diversifiable risk is very high. And that's good. So if you're on top of your game, so long as it's not a surprise and you have some reaction time, you can diversify, you can hedge out your portfolio risk if you've only got one or two or three or four stocks, right? And that's diversifiable risk up in this component of the chart. If you own 40 or more or 100 stocks, you've lost your diversifiable risk. And your portfolio movement is mimicking the movement of the underlying market. And so effectively, you can't hedge out your risk, right? And that's here again, this is, the slide talks about total risk being your systematic risk and your unsystematic risk. And obviously, as a portfolio manager or as a personal investor, what you're trying to do is, through stock selection, you're trying to drive up your unsystematic risk because you're always dealing with systematic risk. You just can't, so there's nothing you can do about it. All right. And so there is a reward for bearing systematic risk, and that reward is the general return on the market. But the excessive returns of really beating the market can only come through stock selection or through asset selection or through investing in the right company if you're a corporation, or making the expansion decision in the right direction at the right time if you're financial management of a company. Right. So we talked about market risk, and the only, coming back into, and by the way, this concept of beta can be applied to private investing and company investing. Beta is the concept of the correlation between a stock that you would hold in your portfolio and the overall market. It is also the concept of correlation between a company you would buy and the overall industry returns. So in other words, if you're in the automobile business and you decide to buy a tire manufacturer, and so you find a small tire manufacturer in southern Jersey that you can buy, and you buy that company, that company's earnings will have some correlation to the overall automobile tire business. So that company's earnings will have a beta coefficient, a correlation coefficient to the overall earnings of the industry. So this concept of beta is very useful. It is mostly used in portfolio management. And obviously what you're doing is you're looking at the correlation of the price movement of stocks that you own to the overall market. And so if the correlation of that stock is exactly on point to the market, beta will be 1. But that means that in effect that your portfolio's price movements are going to correlate completely with the market. That's not necessarily what you get paid for when you're a manager. When you're managing money for investors, you're getting paid to find stocks that will outperform the market. And you're getting paid to take those risks at the appropriate time. So clearly, if you're a portfolio manager and you think the market's going to get clobbered by, the Russian nuclear threat and rising unemployment and rising interest rates and, that sort of thing, then you would allocate some of your portfolio to short-term government bonds. And the flip side is if you thought that Russia and Ukraine were going to sign a peace treaty and that war was going to stop, and the Fed was going to stop raising interest rates, and so rates were going to go down, and money was going to become cheaper, and earnings of major companies were going to rebound, and maybe there even would be a rebound in the purchase of homes and the refinancing of mortgages, and so that the banks would actually make some money along the process too. Then what you might do is you might extend the beta of your portfolio so that you'd capture not just the profits of the market, but you'd actually would go better than the markets. And here, this sort of explains it, right? So if the market, if you want to build a portfolio that has average risk and is going to trade along with the market, you buy stocks that have a beta of 1. If you are worried about the stock market and you want a less volatile portfolio, you buy a stock with a beta of less than 1. That's this line, sorry, the third line. If you want to capture returns because you think the market's going to go great, then you would buy a stock with a beta greater than 1, right? And most stocks sort of bounce around between 1/2 and 1.5. As I said, the beta of the market's 1, but there's definitely some stocks that are highly volatile whose beta is dramatically greater than the market, so greater than 1, right? The flip side of this is, as I said, if you're worried about volatility of the overall economy, if you're worried about volatility of the markets, then you could move some money into short-term U.S. government securities, the primary one being Treasury bills, which is 1 year and shorter, right? And the beauty of Treasury bills is that you buy them at a discount. So you don't have to worry about getting paid interest and all that stuff. You just buy it at a discount and matures at face value. The beta of a Treasury bill is 0. The Treasury bill, has no correlation to the stock market, and it has almost no market risk. So you're not going to get a lot of capital gains in the T-bill market. If you want to buy 1 year bills and you trade them very carefully, you can get a little bit of capital gains. But in general, if you buy 3-month bills, 6-month bills, you just hold them to maturity, or you sell them when you need to, your capital risk is very low and it has no correlation whatsoever to the stock market, right? So just to give you a sense, right, remember I said that certain, and this goes back to 2015, this chart has changed dramatically, but looking at this, you can see there are certain companies that have higher betas, are more volatile than the market. Tesla's beta is still well above 1. Citigroup's beta has gone down a lot since 2015. All right, and that's because they're making a ton of money, and deposits are way up and so on. Google's beta got way above Home Depot. Google's beta got up around Tesla territory back a couple of years ago, right? And in large part because we were stuck at home, in large part because we were working from home, in large part because we were using Google's services of search a lot more, right? Plus Google bought a couple of companies that we were using a lot more. So Google's earnings really accelerated. So, but the main point here is that you can buy good companies whose betas are much higher than 1, And the other thing to remember is that beta is a concept that is constantly in flux. So the beta of companies isn't static. It isn't good for a year. All right. And you can see this on Bloomberg, right? If you go to Bloomberg, they'll list the beta. I think they even list some betas on Yahoo. So effectively you can figure out, how volatile the stock is that you're buying on a company basis. You've got to build your own beta chart. So you've got to look at the earnings of the company over a period of time based on economic conditions, based on industry conditions, and you'll be able to tell if this company you're buying has earnings that are more volatile, the same as, or less volatile than industry earnings, right? And then it just comes down to, given your investment style, and again, this is both inside of a company as well as outside of a company, given your investment style, what are you going to do with your investment dollars? Are you going to take real risks? Are you going to buy companies that have highly volatile earnings, right? And maybe even have earnings that are highly correlated to the company whose money it is where you're working? Or are you going to buy companies that are totally not correlated, that have highly negative betas, that have non-correlated earnings, and whose earnings are relatively steady? And we saw that in that chart. A lot depends on what your mission is with your investable capital. A lot depends on your view of the market in the future, right, or the economy. And if you think the economy is going to be good, and if you think that impact on the industry in which you're operating is going to be good, then you want to buy companies that have highly volatile earnings, that in effect have betas greater than 1. Right? So this again goes back to sort of public market investing, right? So the question here is, and this is investment theory, I'll do this relatively quickly. Company C has a lower standard deviation than company K, and company C has a higher beta than company K, right? So in effect, the earnings in company K, the price movements in company K is fairly broad, right? And the beta is lower. So which company has more systematic risk? Well, the company that has the higher beta has the higher systematic risk, right? And what company should have the higher expected return? It's beta times standard deviation. So it's 2.5 versus 2.8. So believe it or not, security K has higher expected returns, right? It's relatively easy concepts. And as I said, I'm not here to teach anyone investment theory, right? But where it becomes important in advanced financial management is to understand that what you're looking to do with your corporate funds is to invest them in a very defined manner. In a very defined manner. And again, this risk premium is really a publicly traded asset portfolio risk premium, right? It's the expected return minus the risk-free rate, R sub F. And so I'm just going to sort of skip over that, and I just want to get down to this third bullet point, which is that you can define the relationship between the risk you're taking in a corporate investment and the beta, the correlation of that corporate investment to the economy or to the industry sector earnings, and so you can calculate out an expected return. And so if you think about it, like I said, you're sitting in the treasurer's office of a company and you've got $10 million to spend, and you're looking at a company and you're going, their earnings are kind of risky. They can do really well or they can do really poorly. So now, in the industry, given that we're in the industry, we understand that the industry projected returns are going to be really good for the next 3 to 6 quarters. So, as long as their beta is greater than 1, we'll make a ton of money by buying this company. It's got highly volatile returns, and it's a leveraged stock because the beta is greater than 1, so it's going to in a sense out earn the industry. So this would be a great place for us great company to invest in. The question becomes, what happens after the horizon that we've analyzed? And that's the problem with investment analysis. All right. And so this last part, which really relates to public security investing, is the security market line, which is this red line, which in effect is the capital asset pricing model, or CAPM. All right. And so effectively, when you're building your portfolio, you're building a series of expected returns, and then you're calculating those returns out based on what you believe is the beta, or what is the stated beta of the securities you're purchasing. All right. And that's the securities market line and capital asset pricing model. And as I said, I'm going to jump over this public market stuff because it is really belongs in an investment course. All right. So, and here again is another reason why I say to you that market equilibrium doesn't really exist. All right. So in equilibrium, all assets and portfolios must have the same reward to risk ratio. But that never happens. All right. All assets and all portfolios never have the same reward to risk ratio. And that, in effect, is how you get paid for making an investment. If everything performed as to expectations, then all we would make is roughly the risk-free rate, R sub F, and there would be no expected market return. The market return would be very low. So in effect, what all you would make is something that would approximate the risk-free rate. And that's just not how it works. Right? So, and here again, just so you get a sense of how this works, the risk-free rate is the 6-month T-bill rate in the United States, and which is probably another reason why the government won't default on the debt ceiling issue. Right? The market return, they use the S&P 500, I use the Dow 30. It just depends on what your personal flavor is. And the market risk premium is specifically the expected return in this case, on the S&P 500 minus the yield quoted in the market on the 6-month Treasury bill. And this gives you the expected return on this asset that you're investing in, asset J. All right. And so effectively, when you're running a portfolio professionally, before you make an investment, you're going to look at what you think the expected return is, because you've got often many, many choices you can make. And so it's like, well, what are we going to invest in this month? Are we going to invest in autos? We're going to continue to invest in oil. Has oil had its run? What about residential home builders? They had a great run. Now they've backed off a little bit. Are people going to buy homes? right? So these are sort of the decisions you make, is what's going to be the expected return, right? And how is that going to affect our portfolio return? And the tool you use is the capital asset pricing model. And here's the formula in case you care, right? And effectively, for a whole portfolio, you run this for every investment you've got, and then you weight it based on the amount of money you have invested. So it's the amount of money in the specific investment divided by the total portfolio value, right? Gives you your portfolio weighting, and then it's just a matter of trying to figure out what is the expected return on the market. And that, by the way, is the really hard part. All right. Sorry. And so here's, for those of you who want to go a little deeper in this, this is a good simple example. All right. And so in effect, you're assuming the market return is 12%. And honestly, it's almost impossible to calculate what is going to be the return on the market. It's way more of a guess than it is a calculation, right? The risk-free rate is 7.5%, so that's your 6-month T-bill rate, right? And so you calculate out the expected return of these two stocks using this formula, right? And you get to a point where the last thing is you multiply by beta, and you come out to what the required return is, right? So your expected return is this, your beta is that, and so here's your required return. And if the market return is 12%, then stock B is overvalued. You might as well just put the money into a stock index, and stock A is undervalued. So there, you might even want to leverage up and buy more of it. And this is what, as a portfolio manager, sort of what you would do all day long. So again, I don't want to go too deep in here. That's essentially it. Okay, that's chapter 11, expected return. Next up is chapter 15, which, if you don't mind, I'll take another 15 minutes and go through it a little bit, and then send you folks home, and we'll take this up next week. But as I said, I will send you an announcement regarding the midterm, so you can start to think about it. So in effect now, we've sort of seen how risk and reward play a role, even in corporate financial management, even in making decisions about deploying our capital. All right. Well, in many cases, in most cases, part of your role as financial management will be to raise capital, right? And a lot of this course speaks to that issue. So, the easy concept is I go to my friendly bank and I borrow money. I'm sorry, I see someone sent a chat. Excuse me one sec. Oh, yeah, someone had talked about GameStop being shorted more than the shares were outstanding. Yeah, it's the funky nature of the lack of regulatory oversight. All right, and I got to, because we're going to talk about raising capital. I'll do this really quickly, but the way shorting works is you have to borrow the shares in order to make delivery of the shares after you sell them, because you're selling something you don't own. So what happens is you go to Merrill Lynch and you borrow 1 million shares from them, and you sell the 1 million shares short, right? They put the shares in your account, you deliver the shares out. You don't know who bought the shares. What you don't know is that Merrill Lynch bought the shares. So Merrill Lynch says to you, hey, want to borrow some more shares? Yeah, why? You got more you can lend? Oh yeah, I got 1 million. Wow, that's great. Okay, yeah, I'll short some more shares. So you short another 1 million shares. What you don't know is the Merrill Lynch bought the 1 million shares again. So now you short, they come to you and go, hey, you still interested in shorting GameStop? Yeah, why? You got more shares? Oh yeah, I got another 1 million shares I can lend you. So that's how these hedge funds wound up short more shares than there were outstanding. They kept borrowing the shares, selling them short. The intermediaries, the broker dealers that were buying the shares, were relending them the shares that they had just sold. And so they created this daisy chain where eventually they got to shorting more shares than there were outstanding. It's just another instance of the lack of regulation on the part of the regulators. So anyway, with raising capital, effectively, when you start an organization, you've got sorry, I just want to get to the beginning. Okay, you've got to go get external capital. No company starts with its own money. There's a lot of different places you can get the external capital. Usually what happens when a company starts is a bunch of people sort of band together and they raise money from people they know. They kick in their own money and they start the company up. And the company, rents an office and starts to design a product and design packaging and trademarks a name and maybe files some patents, right? And hires a bunch of employees. All of that takes money. So at some point, unless one of the shareholders has incredible wealth, at some point the company's got to go find outside capital, external capital. And frankly, even if one of the shareholders is extraordinarily wealthy, generally what happens is that extraordinarily wealthy shareholder says, look, it's time to go find some outside money. So the first stop is one of these pools of private capital that exist to primarily fund up these new companies. And that industry is broadly called private equity or venture capital. And in that industry are very wealthy individuals, family offices, funds that are set up to manage money for other people in this high risk type of investing, right? And so this group of this industry is always looking for the next good idea. And this is, I think I've told you folks, I'm a Shark Tank junkie. This is what Shark Tank does, right? So you've got, 4 or 5 different investors sitting listening to the investment pitch from a company that's usually a startup. If they have sales, the sales are usually relatively low. Every once in a while, a company will sneak in that's got higher sales, but in general, the sales are relatively low. And these investors are looking for substantial returns. And what they know is that a lot of these companies will fail. They'll either, fail to reach a certain level and therefore be worth what they like them to be worth to get the return they'd like to get, or they just totally fail and they go out of business. But some of them in a broad portfolio, remember the power of diversification, some of them will make it to what's called the exit strategy, which effectively is being sold to someone. And in the process of selling the company to someone, there's really only 2 choices, if you think about it. Right? One choice is that the company goes public and gets sold to the public through what's called an initial public offering, an IPO, or it gets sold to some other large pool of private capital, either a competitor, a hedge fund, some form of private capital that buys the company, and then their goal is to manage the company to a point where they can sell the company. So the first step is venture capital or private equity. They're used to high-risk businesses. They almost always buy stock. They sometimes will use convertible bonds as part of or all of their investment structure. And they are usually fairly active investors, meaning that because of the high risk portion of this investment strategy, they're deeply involved in the company. So one of the downsides for management of the company is that not only, I mean, the good news is they're going to get money from the investor. The bad news is the investor is going to be all over them to talk about what happened to the money and how it's being spent and what's the, what are our goals at this stage and where are we going to get to. And the basic goal here is to launch the company by getting to having a product or a service that can be sold or maybe even has been sold a little bit. And then the next stage is to acquire more financing where the company can expand its business reach. So in a manufacturing company, you'd go from the prototype stage to a full-blown manufacturing stage. With a service company, you'd go from a few advisors / consultants to hiring a lot more people, and maybe even having a little more professional processing group inside of the firm, so that the reports look better and the presentations are more powerful and more professional, right? And so that gets you to the second stage, which used to be called mezzanine financing, which is now really called launch financing. So step one is it's really still called friends and family financing, because that's generally where you get the money, and then towards the end of it you get into a private capital, venture capital phase where you can get a little bit more money, and then the launch capital where you really build the company out comes in the second stage, which used to be called mezzanine financing. As I said, venture capital money often carries with it all kinds of both help and oversight, right? And they're, in a sense, they're very similar. They're trying to direct the company to reduce the instance of failure, right? And so effectively, and they're pushing very hard for an exit strategy. They want their capital in and they want to get their capital back out, right? And so effectively, venture capital, from the moment it lands till the moment it leaves, is looking at the exit door, right? And so as an owner / manager of this enterprise, part of what you're looking at is how much can the venture capitalist help us, or the private equity fund help us with real money? I mean, how much money do they have? How much money do they have available? How much money can they help us with? The second is, what's their vision of our management style? Are they coming in to try and change our management style because they like our idea and think it's pretty good? Or are they coming in to help us make our management style better? Because that's where a lot of friction happens. And when you see a CEO leaving a startup company relatively early, it often happens because there is a conflict with the initial investors, all right? And then you get down to trying to figure out, can we live with this firm? And that requires, in a sense, a reference check and so on, right? Then you get to the point where finally the company is doing well enough that you can create an exit strategy for your shareholders. Sort of the painful exit strategy is you sell the company off to a competitor or another, some sort of industry investor. And frankly, the minute that happens, they're looking at you thinking, how soon can I get rid of this person? I don't really need him. It's just another salary, unless you've got specific talents that they can use, they're always thinking about, let's get them out the door, reduce costs, and we'll run the show here. If you're taking the company public, then of course your job is very secure, and that's why a lot of these companies, the step that they want to go through is they want to take the company public, right? And it's a total playbook that you have to follow, right? And it starts with management making a presentation to the board of directors. The board of directors approves the company going public. Then management starts to interview investment bankers, because you need to have some company to work with that's got the license to take you public. That's Merrill Lynch, Morgan Stanley, Goldman Sachs. The next step is you have to file a registration statement with the Securities and Exchange Commission. This will often cause a company to have to change their lawyer and change their auditor. So in effect, your good old auditor from around the corner that has been your friend since high school and now is now a CPA, they ain't going to cut it in the public markets. So you're going to have to go find an auditor that is acceptable to both your investment banker and the SEC. And if you don't, getting through the SEC is going to be very hard, because they're going to make a series of comments. What happens is they assign a couple of analysts to your filing, and the analysts break the filing apart and start looking at the various pieces, and they start making all kinds of comments. And so they give you comments, and they expect you, as company management, to react to those comments. And then the other part is that you need an attorney that understands this process. You can't do it yourself. And if you could do it yourself, your investment banker is not going to accept that. So if you had as an attorney, some great firm within your town, but they were two lawyer shop, you may have to fire them. Or actually, generally what happens is that they help you hire a big firm, and then they stay on as the big firm stays on as corporate counsel, but they do a lot of the work, so your bill's less. But you got to get yourself a bigger name lawyer and a bigger name auditor. Otherwise, you're just not going to get through the SEC. And as I said, the SEC is going to be reading your file and giving back comments, and they're going to expect your company to react to those comments, which could be just the provision of more information and so on. Eventually, you get to an approval. And once that approval happens, you have a 20-day waiting period. During that 20-day period, the SEC can make additional comments, but you've got an approval to go public, and your investment banker starts to do work on lining up investors, right? And so the securities aren't sold during that period, but you can market the securities during that period. You can talk to potential investors, and your investment banker can talk to potential investors. And then finally, when the 20-day period is over, and presuming that that you have enough potential investors, you can then take the company public by putting a firm price on the shares and letting them trade in the public market. Now, during the waiting period, you can give and should give and will give investors information about the company, and that comes through a prospectus. So the SEC registration becomes a document called a prospectus, and the prospectus has two forms, if you will. One is preliminary and the other is final. The preliminary prospectus is called a red herring, and it's called a red herring because on the left-hand spine of the document, there is a warning that is printed in red so you can't miss it, that essentially says these securities have not been fully approved by the Securities and Exchange Commission. They have not been approved to trade in the market, and this document is only being provided to investors to give them information about the pending transaction, right? And that's why it's called a red herring. So once the company can price, once the 20-day waiting period is over, once the shares are finally approved for issue in the market, once the investment banker says, okay, we're ready to go, then the investment banker suggests a price to the company. The board of directors approves that price. The stock gets priced generally between 10 and 11 o'clock in the morning, and the shares start to trade in the public market. And none of that can happen until the waiting period is over, right? The next step is that the prospectus, which had that red warning on the left-hand spine of the document, gets reprinted as a final prospectus. The red warning goes away, and the names of all of the firms that acted as what's called an underwriter, so they were willing to commit some of their firm capital to buying the shares from the company and selling the shares to the public, their names go on the front cover of the prospectus, and now you've got a full public issue. All right, so look, it's 8:30. I'm going to leave it here. I'll do this next class. I'll do this, and I'll do the exam prep. All right, but you will get an announcement from me about what the exam's going to look like. You will get a poll from me as to where we're going to have the exam, and I know what you folks want, and I'm leaning to making this easy for you and making you happy and putting it online. It just, as I said, I'm sort of navigating some of the issues within our school and my department. All right, any questions? All right.
I had a question after maybe the class for like a half minute.
Yeah, sure, no problem. Do you want to wait till everyone